three stocks at 52-week lows: CRM, ZM, Gold. That's Salesforce, Zoom, and Gold, which follows Gold itself. So 52-week lows are a great place to start to look for value plays. Just because a stock's at a 52-week low does not mean that it's a value play though, but it's a great place to start because if prices have fallen significantly, it may be an indication that people have exaggerated what's actually happened. So my goal is to sit there and look at all the 52-week lows as they hit and determine if there's a value play here or if I have to wait a little bit longer. Low, middle, and high for earnings and low, middle, and high for free cash flow. If it's all green, pump the brakes. Don't necessarily go out and buy. Your goal then is to verify these numbers. So your next question is probably like, well, how do I verify them? Several ways. Go read analyst reports. Go read what people think against the company and for the company. Go read both sides of the argument in favor and against CRM as an investment. But biggest thing of all, join our community. For less than a cup of coffee per day, there are thousands of people in here talking about investments. I'm sure hundreds have looked at CRM and they'll have some sort of insight, or they'll have something to say, hey, do you think about this? Because remember, it's much easier as a group. Use the herd mentality in a good way. Don't use the herd mentality in the market way of fearing things that shouldn't be feared. Go use it for a like-minded investor. Because if you're like me and you're staying in this video long enough, it means this probably makes a little bit of sense to you. So let's use our 8 pillars process and our stock analyzer tool to determine what we want to pay for these 3 stocks. Now, if you're new to this channel, I'm Paul. I'm a value investor. My goal is to find where price and value don't meet and where price is below my long-term value. I don't get affected by quarter-to-quarter earnings results unless they're giving a long-term problem and showing a long-term problem in the business. I believe that over any period of time, stocks are overvalued or undervalued. My goal is to find opportunities when stocks are selling for below their actual value long-term. It takes a certain insight, not just the numbers. It takes a certain emotional aspect to be successful at that. So if you like what you hear, subscribe to the channel, watch more videos. And if you want to learn more about me, go check out my Instagram where I put up lots of pictures of my cute puppies. So let's pull up our software. And if you have our software, please follow along because it's a great way to get used to it. So CRM is Salesforce. They do a lot. They have their own software. We used them before. They're a great software business. So let's check out some things from a high level. No dividend, which makes sense. Pretty solid cash flow. I like this. $4 billion over the last 5 years, but 5.7 in the last year. And I'm actually surprised by this 5-year return on invested capital. I thought it'd be higher because software businesses tend to have a higher return on invested capital. What is return on invested capital? It basically shows me how is the company allocating the cash that's invested in the business? Are they getting a good return? We want to make sure that their return on invested capital is greater than their weighted average cost of capital, which means how much money are the equity investors and the debt investors expecting from the company. Something tells me this isn't high enough, but they could be running a lot of their growth through their free cash flow, which pushes down their return on invested capital. All right. So let's go check out the 8-pillar portfolio. Sorry, the 8 pillars here. All right. A lot of X's here. Now, remember, this doesn't mean we ignore it immediately, but we use the 8 pillars to sit there and tell me a story of questions I can ask going forward. So one thing I don't like immediately, 40% increase in their shares outstanding. This means they are diluting the heck out of investors. If they had 10 shares outstanding 5 years ago, now they have 14. So they've diluted everybody by 40%. You're getting 40% less, essentially. I won't get into the exact math, but 40% less of the revenue, cash flow, and profit you're getting before. So if over the last 5 years they've grown 40%, but they've issued 40% more shares, you have gained nothing as an investor because now they're splitting it up amongst more shareholders. Look at this 5-year PE, 105. 5-year price of free cash flow, 37. Now, I'm happy that the free cash flow numbers is less than the PE number, but it's still a very high number. Does that mean you ignore it? No. Remember, high multiples for companies can be justified with a lot of growth and a high return on invested capital and moat, okay? That could be the case here in terms of moat and growth level. $17.5 billion in increased revenue led to $3 billion in increased free cash flow, but a decrease in net income. I'm actually not as concerned about this. A fast-growing company like this, they might be investing a lot of their growth from their P&L, and that could be affecting their net income here, but the cash flow could still be significant. There could be a lot of write-offs going on here from previous investments in the company. All right. So what do we do with this information? This is the important part to understand, and I'm going to spend a little more time on this company. That way it's easier on the next two companies. This information is to sit there and tell me, hey, what questions do I need to ask? But remember, this doesn't tell me what price to pay for the company. Yeah, I could sit there and say, hey, I should pay 25 times or 20 times, but really we don't know. Why? Let's say hypothetically you had two companies. They both had the exact same revenue and profit and balance sheet today. But one was going to grow 100% a year and one was going to grow 5% a year in terms of its revenue. Which one would you pay more money for? I think we'd all agree that you should pay more money for the 100% growth, right? Why wouldn't you? It's going to grow much faster. It's going to drive more net income and more cash flow at a faster pace. So that's the thing we have to consider. So that is why we created our stock analyzer tool. This was created specifically because we don't know the future, but we know that every investment is the present value of all future cash flow. But since we don't know the future, we have to make assumptions about the future. This 8-pillar portfolio kind of tells me, hey, listen, there are certain things here. We have to I'm looking at this saying, I need a much higher growth level for this company to justify this investment because they're diluting and they're selling at really high premiums. Okay, so I'm going to use a stock analyzer tool here to look at those assumptions and determine what I'm going to do. But what assumptions should I put in? Well, we have the analyst estimates over here. I'm not a believer in saying that analyst estimates are the be all and end all, but it's a good place to start to get a feel for where these analysts who follow the company every single quarter might look at. Now, right now, 52 analysts are reporting this year that they expect $4.73 in profit. Guys, there are so many analysts out there following CRM. Our data feed provides 52 of them. But here's the interesting part. Look at this. 473, and they're looking to double in the next 5 years based on 22 analysts giving their estimates and their ranges. In terms of revenue growth, look at that. Low to mid teens. That's pretty high. And pretty high number of analysts looking at this. 26 billion to 57 billion. Okay, so there's a lot of growth potential looking at this company, right? So let's go to the stock analyzer tool and put some of these assumptions in. Now, revenue growth over the last 1, 5, and 10 years. So first off, I'm doing a 10-year analysis. On our software, you can do between 1 and 20-year analysis. I always pick 10. It's just my standard go-to. And we're going to show the 1, 5, and 10-year numbers on the revenue growth, profit margin, and free cash flow margin to see if things are consistent. But look at this. I mean, this is pretty consistent growth year in and year out, right? Now, if you saw the revenue growth percentage for the next 5 years was 15%. The longer and longer you go, the lower overall growth will probably be on most companies, right? Because the bigger a company is, the harder it is to grow. It's much easier for a company with 1 billion in revenue to go to 2 billion than a company in 100 billion in revenue to go to 200 billion in revenue, right? So you have to factor that in when you're doing this. So I'm going to go revenue on the high side where the analysts were, but that was on 15% a year for the next 5 years. So maybe I'll go 13% for 10 years. I might go 10% for middle and 7% for low. Now you might sit there and say, boy, that seems really low. My goal as a value investor is to be conservative and look at 10,000 stocks out there and be conservative and find the 20 to 40 that fit my criteria. It's so hard to see what's going to happen in the future. And you'll see in all of these that things are going to happen that we don't know about. Imagine all the things that have happened in the last 10 years that you never thought would happen or you never expected to happen. Still, things happen. So you got to be conservative and buy stocks that are selling for underneath those conservative estimates. Now, profit margin. So here's the interesting thing about profit margin. It's been lower lately, and it's been 5 to 7% over the last 5 and 10 years. You know, I'm not going to lie. I think that's kind of low for a company like this. Their gross margin was 72%. That means every extra dollar of revenue they bring in, 72 cents of it goes to the bottom line. So once they slow down their growth and they're more organic, it'll probably drive that profit margin up. So I'm going to be conservative and say, hey, they're still going to do low profit margins as they grow, but it might get a lot higher. 7, 12, and 17. Those are big jumps, but you'll see how I factor that in a little bit later. Free cash flow margin. Now look at this. Here's why I know that profit margin is going to increase. I actually should probably go higher than 7, 12, and 17 because over long periods of time, free cash flow and earnings should be pretty similar. Now, obviously, they're not going to be exact, but very similar. If you start a business and end a business over a 10-year period, free cash flow and earnings should be the same, okay? But this is an ongoing business, so there'll still be differences. So I'm going to pick 17, 19, and 21. Now for PE, 282 is their current PE, and their price to free cash flow is 27. Now their current PE, as you saw, was based on 1.8% profit margin. If you just make that 10%, their PE drops to 50 or 60, which is still very high. Now, for a company like this, it's hard to determine a PE, and this is part of the art of investing. All of this is part of the art of investing. Because after all, if we knew the future, we would know exactly what to pay for the company. It would just be pick your determined return and discount it, and there you go. That's your price. But we don't know the future. So for PE, I'm going to go 14, 17, and 20. For price to free cash flow, I'm going to do the exact same thing. Now for my desired return. Guys, I do think I was being very conservative here. So I don't think I need a really high desired return here because I'm already being conservative. I can get 9 or 10% by investing in a long-term ETF. So for me to have some sort of margin of safety and a reason to buy this, I want a little bit better than that. So my middle level, I'm probably going to do 12.5%. My low level, my middle level 15, and my high level 17.5. Because I think I was very aggressive here. And I sit there and say, hey, for this to happen, what needs to happen in the business? I want to be conservative here. A lot of things can happen between now and then. They could end up blowing these numbers all out of the water. Sure, maybe, but I want to be conservative. Now, I'm going to hit the analyze button. Now, guys, what you're hearing right now, if it was confusing, rewind the video and do the stock analyzer tool again. My goal here over and over, and we have 1,700 videos that you can watch where we talk about stock analyzer tool. My goal over and over is to be conservative. I hit the analyze button. It's going to pop up 6 numbers for me. And being a value investor is a very lonely road. When I started as a value investor, I was so lonely because nobody was out there to talk to me. But I didn't realize it then. Now when I go in here sometimes just to see what people are saying about different investments I make. So all this is available for less than a cup of coffee per day. Go to everythingmoney.com, check it out. Scrolling down below. Okay. So we have a low of 33 to 80. And remember, it's because of our big difference between free profit margin and free cash flow and our high of 107 to 130. Middle ground somewhere under 100. So you know what I'm going to do? I'm going to add this to my watch list at 104.59. I'm going to just change it to 105 and notify me. So our software is going to notify me when it goes below 105. And I wait for then before I do any more work because there's no reason to do work when it's not near my number quite yet. All right, Zoom, ZM. Let's go check this out right now. Go back to our main page, ZM. Now guys, Zoom is a darling of Cathie Wood. This stock just 2 years ago was $568 a share. It is now 80. Now here's what I want to accentuate here. That is down, what, 80%? More than 80%. 85%. Look at the income statement. The revenue's up over 2 years ago, big time. So if I told you 2 years ago that the stock was at 560 and revenue was going to over double, what would you have said to me? Oh, the stock's going to go to the moon, but it didn't. Why? Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. It means what's behind them, the fundamentals is going to win. Don't overpay just because the future feels bright. Remember, we were just coming off COVID. And Zoom was a big thing for COVID. It was absolutely necessary. And it's been good for them even afterwards. Even now, I just signed up for Zoom Premium the other day. Just me, myself. I didn't have it for the last 2 years. I finally did. I'm like, you know what? I'm sick of this 40 minutes thing. I'm just going to sign up. And I'm happy I did. So let's go check out some high-level metrics. Pretty decent return on invested capital. No dividend, which is understandable. Increased free cash flow. 5-year average of $600 million. Last year was $1.3 billion. High gross margin and a high profit margin. Okay, this is great. Let's go to their 8 pillars. Okay, I don't blame them. They issued a lot of shares. Why? Expensive as hell. So when the stock was really high, the smart people at the company said, listen, the stock is really high. Why should we take on debt at X amount of dollars, $1 billion, when we can go issue $1 billion worth of shares and we think we're giving out overpriced shares? So let's just go give it to people and take the shares out there, take the cash from the shares. And when we dilute them and the stock falls, we got cheap money. That's the idea there. Look at this, guys. Look at this debt level. Only 0.3 times. They have such low amount of debt. I love that. It's hard for companies that have low debt to go under, right? It's just like you personally. If you had $0 in debt or 10 million, which one's more likely to go under? It's pretty obvious. So let's go check out the analyst estimates. Now I will say, look at this. Earnings per share is expected to drop from $5 a share. It's actually going to go down before. It's actually showing very flat earnings EPS growth over the next 5 years. So keep that in mind. Revenue growth, though, they are looking at big revenue growth. So how is that? How are they doing revenue growth of mid to high single digits and earnings per share higher? maybe dilution. If you increase the number of shares outstanding, it's going to drive this EPS down. So that's something to factor in there. To me, I would put that in my desired return in the stock analyzer tool and put a higher threshold for that. So let's go to our stock analyzer tool and put the data right here. Revenue growth. I'm going to do 3, 6, and 9%. Profit margin. I'm going to do 18, 21, and 24. Free cash flow margin, 22, 25, and 28. And here I'm just doing it based on, when I see this, there's not a lot of track record. I want to be more conservative. That's it. Very simple. Now PE, I'm going to go 13, 15, and 17. And same with price to free cash flow. And so they're almost there right now, guys. Look at that. But they're going to drop in their profit. So remember that. This PE will probably jump up a little bit. Now for desired return, let's see here. Desired annual return. I think I'm just going to do 15 across the board. Hit the analyze button because I really don't know where to be. And I really don't know whether low, middle, or high will be any different. You know what? Let me do it a little bit different. Let me do 13, 15, and 17. Hit the analyze button. So the stock is currently at $80 a share. All right. Still has more to go. A low price of around 30 to 35. A high price of about 60, middle price of 46, 38 to 46. So it still has more to drop based on these assumptions. So before we go any further, let me go and show you. Let me take these assumptions to a higher level. Instead of 3, 6, and 9% revenue growth, let's go 10, 15, and 20. It's barely in my green right now. That just shows you how important these numbers really are. So 3, 5, and was it 3, 5, and 7? I don't remember what it was. Let me go back to my history here and go to my original 1, 3, 6, and 9. And that's the great thing about the software. You forget what you did, you can go to the history right there and plug it right in. All right, so I'm going to add this to my watch list at $50. So I'm going to hit 50. I'm going to take this back, go to 50, notify me. All right, so that's Zoom right there. All right, next stock, GOLD, Barrick Gold Company. So full disclosure, I don't own any individual gold miners, but I have GDX and GDXJ because I've thought that with inflation, that gold will really skyrocket. It has not yet. Are there reasons for that? Sure, there can be arguments for it, but that's my take. Now, I'm not telling you to go buy anything based on that, but look at Barrick Gold's stock price. Hit a high of 26, and now it's at 14, $15. All right. Free cash flow. Average is 1.5. Last year, 1.76. Now, one thing I want you guys to remember, when it comes to businesses that need to make money off a commodity, you got to watch the commodity price. So I think in this situation, if you believe the commodity has room to grow, this is a way to buy a company that kind of makes money off that. So let's go right to our 8 pillars here. Okay, whoa. Shares outstanding, 52%. I want to go see why that is. Let's go to our income statement. That's where the shares outstanding is. Okay, something tells me there was an acquisition here because you see how it goes from 1.17 to 1.78 and stays flat? That big jump is probably from an acquisition. And that was in 18 and 19. So let's go to the cash flow statement and we'll scroll down to the acquisitions portion. And they did a few acquisitions along the way. Back in 18 and 19, they spent about $1 billion in acquisitions. So 70 million shares, 600 million shares. Okay, that makes about sense. Okay. So let's go back to our analyst estimates now. So analyst estimates are very flat for earnings per share. Look at this. Very, very low. Look at this growth rate. Very low number of analysts, but we're in the low single digits here. Revenue growth, all over the board. Again, very little growth. So are analysts right? We don't know. Because remember, at the end of the day, what matters is gold prices here and a big chunk of this. If all of a sudden gold prices doubled, you better believe these guys are going to have a huge profit and the stock's going to go up. So let's go to our stock analyzer tool and let's be very conservative here. Let's go with -2, 2, and 6% profit margin. I'm going to go with 12, 15, and 18. Free cash flow margin, I'm going to do the exact same thing. PE, I'm going to go with 12, 14, and 16. And same with the price of free cash flow. Because it's really going to fluctuate based on where gold is. Now, I will tell you on this one, I'm going to go 15% across the board. Because I don't know whether it's going to be, gold's going to go up or down. I am still making a bet on gold long term. But we hit the analyze button. We're at $15 a share. All right. Low side, 6. High side, 16. Middle price, 10. So if you believe this high side, definitely go do more research. If you like this video, please check out our next video all about margin of safety and how you can learn more about it. And don't forget to subscribe to our channel. Thank you very much for your time.